All right, so this is assignment 3. And assignment 3 consists of so we did working capital, we did CapEx, we did debt profile. All that's left is it's cash waterfall. No. We're going to pause this for 1 second. 1 second. So this is the second to last assignment. So we'll be covering the financial statements, waterfall, and evaluation. So this is a pretty comprehensive section. Let me fix the Hangouts. Let's do that. There we go. All right, perfect. So cash waterfall, income statement, cash flow statement, balance sheet, and valuation. So these are probably the most technical part of the assignment. It's going to require a lot of accounting. So we'll start with the cash waterfall. So the cash waterfall just takes basically your revenues minus your expenses. And then it also takes away your CapEx and your working capital and your taxes, and you get to this CFADS number. So CFADs are very important. It's called cash flow after debt service. Or really it's cash flow available for debt service. So we'll write cash flow available debt service. It really just means the free cash that the company generates to pay the debt. So really it's pretty straightforward waterfall. So here, let's lock the cells. So we'll start. So really, we're just looking at the cash waterfall during the amortization period. So you pull your amortization flag from your debt profile tab. And that's really all we're looking at. And then it's just then you just link the cells from the previous tabs. So you pull revenues from operations, you pull your fuel from operations, your fuel cost, your variable L&M, operation and maintenance from operations, fixed from operations, and then your maintenance from operations, and then your working capital. This comes from your cash flow statement. So we'll be kind of interlinking these. We'll be interlinking a lot of these things from different cells or different tabs. So really it's the three statements, the three real statements is your income statement, cash flow statement, and balance sheet. Those kind of interlink with each other. And that's kind of, it's kind of an important, I guess, accounting concept. And so I'll just list to where these other ones come from. So then this comes from ops tab, and then CapEx comes from the cash flow statement, and then taxes all come from, I think this one comes from income statement. Yeah. And this is from your income statement. And another name for the income statement is the P&L, the profit and loss statement. So once you just link all those cells, so we'll trace it here. Let's trace these last two. So if you go to formula, trace precedent, you can link back. And so you're just kind of pulling it from here, and then we'll get to this one next. So where was it? Your increase in working capital comes from S9 or the 9th row, so right here. And then in turn here comes from your working capital tab. So realistically, you can link it both from your working capital tab. This is the way we have it here. And then CapEx right here this comes from your CapEx tab. And really it's done like this, where we pull it, really your cash flow waterfall is a secondary accounting tab. Like your income statement, cash flow statement, and your balance sheet, those are the primary accounting tabs. So really you build those three out, and then you kind of, then you build the cash flow statement. That's kind of like your process if you're doing this from scratch without a template. All right, so back to the cash waterfall. So just get these things linked up, and then you sum them, simple sum, and then you get the CFADs, cash flows available for debt service. Then your debt service total comes from debt profile. And then you get your DSCR. So DSCR is really important. It's called debt service coverage ratio. So it's kind of like a fixed charge coverage. It's basically the amount of cash you have to pay your debt divided by the total debt service for that period. So it's kind of just like capacity to pay debt in that period. So when we measure CFADs, we measure capacity to pay debt, each period is a discrete period separate from each other. So we kind of analyze each periodic period's discrete ability to repay debt. And so we calculate our cash flows available for debt service for each period, and then we figure out what our debt service is for that period, and then the ratio of the two is your CFAD. So a 1 CFAD means there's an equal amount, or your DSCR. So a DSCR of 1 means there is an equal amount of cash available for debt service to debt service. So that means you generated just enough cash to pay your debt service. So really, there's usually like a test. So generally in project finance, it's usually a DSCR covenant of 1.25 or 1.15 that you want, kind of like a clear, you want like a cushion available to you. So you want like a cushion there, like a covenant, to make sure that the business is producing enough cash to repay debt and then also repay your equity holders. So you can see in certain periods, your CFAT or your DSCR is below 1. That means it's in technical default. So there's default mitigants that we're going to go through. Like you're going to build out a debt service reserve account. You're going to build out some other ways that you sweep cash, that you block cash from leaving the SPV to go to the equity holders, and you're trapping that in the company to pay future debt. So that's going to be part of the next assignment, is you're going to have to learn how to put these, I guess, credit enhancing mechanisms into the model. And these all manifest themselves as different parts of like a credit agreement, or this all shows up in the credit agreement as different terms. So let's say the application in real life. So you kind of build this model, you go to the negotiating table and then you negotiate with the company and be like, hey, these certain periods you guys don't pay our debt and we need some credit enhancements for these periods that we're not giving you money. And that's kind of how it works. So they negotiate over the credit agreements. And so you kind of notice that every year where there is a maintenance or a CapEx event, there's not enough free cash generated to really pay debt as well. And so these items are senior to debt just because you need these to run the business. And then you'll see that equity is below debt, so it's subordinated to debt. And then this will become more clear as you guys build out the debt service reserve account and these other control accounts that are credit enhancements. So it's basically your DSCR, debt service coverage ratio, CFADs divided by debt service, and then you're going to want to see your average. And then be careful of the average, because if you get too many zeros in here, make sure you put a code in here that eliminates zeros. It will draw down the whole average. You want this to be blank. So if this equals 0, make it blank, and then your minimum. You do the min function. And then down here is your minimum debt to break even. And that's your revenues. It's basically it's the change. It's basically how much revenue can drop before to get your CFADs to 1. So, to get your DSCR to 1. So right now, revenues are 81 million. Then you take out your debt service. And then, you find the difference between your CFADs and your debt service. So the delta between the two. And then you divide that by your revenues. And that's how you get your debt service to break even. So it's kind of just how much cushion in the revenue, like your revenue can decline by 5.6%. And then your CFADs, you can still cover your debt service. So you notice that it's all positive here. But then you see where it's negative, your revenue is actually need to increase for you to cover your debt service. So it's just another credit metric. Kind of see what discrete periods where there's kind of a credit event, like a shock. So these are issues. So that's really what we're doing, is we're on the debt side. So really, we're not kind of like equity investors. Like project finance is debt. So we're not really looking at what's the upside. We're kind of just analyzing what are the downsides and what are the weak points at very specific points. So we're almost like a structural engineer where we're trying to find where are the weakest spots. And so that's why we're analyzing each period individually. Those are the weak spots where bankruptcy would occur under these assumptions. We have a few here. So that's kind of how you do debt service or debt to break even. And then you just want your minimum. Then all the stuff down here is stuff for charts that we'll calculate later. So that's your cash flow tab. And it's going to get more complicated as we do eventually we're going to do a debt service reserve account. This one's going to be pretty tough to make, but it'll be coming up. And then, so next we'll go to the accounting statement. So it really starts with the income statement, or the P&L. Profit and loss is another way to call it. This is kind of where the class gets more technical. This is all accounting rules. So if you guys have any trouble with understanding the concepts, there's really no way around it. You kind of just have to like accept accounting for what it is. It's not really intuitive. It's not really, it's not like something that's naturally. It's just you have to kind of just memorize what the rules are. So the difference between your income statement and your cash flow statement is that your income statement includes a lot of like accruals. So it's not true cash. So your cash flow statement is the actual cash. Oh, where's the cash flow statement? Is the actual cash in and out of the company. So this is all cash events that happen. So this is kind of like your debit card, or if you had cash in your wallet before the weekend, you had, say you had $100, and then you owed someone money. You got someone paid you for the money they owed you, and then you spent money at dinner and drinks or whatever. And then the amount of cash in your wallet that you have at the end of the weekend, that's kind of your cash flow statement. From the beginning, your cash balance in the beginning, and then cash balance at the end. Your income statement is more like your credit card. So say you have your money coming in, which is in this instance, it's very straightforward, where we're just whatever revenues we have that period is what we realize. But in other instances, there's a lot of accruals and things taking out of time context. So really, this is say you have your money coming in, and then say you bought a car, or you bought, I guess, a really nice clothes on Black Friday with your credit card, but you're paying that off every week. So it's going to take you, say, 6 months or 3 months to pay off your credit card balance from all those cards. So here in your expenses, you would kind of realize how much you pay off your credit card each period. So really, it did cost you, say it cost you $1,000 for that dress, and then you're paying it off $50 a week. And so you'd see the $50 a week here, even though it was $1,000 initial outlay. So if you paid on here on your cash flow statement, you would see a $50 like loss in your so it would kind of show up in financing cash flow, or sorry, in investing cash flow. So you'd see a $1,000 cash outlay in investing on that dress, and then you would see a debt drawn of $1,000 from your credit card. And then the next period, you'll see the repayment of $50 each week for that credit card. So that's kind of the difference between the cash flow statement and income statement. So I'll say that again. On the income statement, you pay for that dress. You pay for that dress on your credit card, and then you pay that $1,000 dress on your credit card, and you pay it off $50 a week. All you're going to see in your expenses, your COGS, is $50 each week. So it's kind of an accrual. It's kind of like not real. It's just kind of like an accounting convention. So it's kind of like your credit card. So on your cash flow statement, when you pay for that dress, that $1,000 dress on credit, and then you pay $50 a week paying it off, you'll see a $1,000 investing outlay into dress, and then a $1,000 cash flow in from your credit card, debt drawn, and then you'll see repayment of $50 each week. So that's kind of how the cash flow statement works. It's actuals. It's cash in your wallet. It really is like it's just different from the income statement. And then your balance sheet is just kind of the balance of all your sources and uses. It's an account of everything you have, is your assets is everything you have, and then your liabilities and equity is how you pay for it. So this is all the assets of the company, and then this is how you pay for those assets. So it's your uses of capital, and then your sources of capital, and you're kind of just keeping an account of how that is. So this is a stock variable. Everything here is stock, and then everything on the cash flow statement and income statement are flow variables. And then you'll also notice on the cash flow statement, there are negatives and positives. Those are all directions of cash. So a positive from the perspective of the company. So the positive money or positive accounts or positive numbers here are money flowing into your company. So you could see debt drawn and equity drawn. That's cash coming into your bank account for the company. And then the construction fees and principal repayment, those are negative. Those are cash coming out. So it's kind of like a direction. And then your income statement is more like a traditional. This is also flow. And then this is more traditional where it's just income, costs, and everything else. And then so I'll go through how they kind of interact with each other, starting from the income statement. So here, give me 1 second. All right, sorry about that. So starting in your income statement, you just pull energy revenues from your operations tab. This is cash into the company is what you make. And then this is your COGS, your cost of goods sold. So it's kind of the cost of the revenue. So this is what it costs to generate this amount of revenue. This is what it costs. So that's kind of like your cost of goods sold. So in a different type of company, you would have cost of goods sold, and then you would have gross profit, and then you would have operating expense, which are kind of like the corporate expenses that are not really related, that aren't really attributable to that specific generation of revenue. So say you sell clothes, your revenue would always be the volume of clothes times the price of clothes you sell it for. So that's your revenue. And your COGS is the labor and shipping costs and material costs for those clothes. So that's the cost of the goods that you sold. And then your operating expenses would kind of be like your IT costs or the costs for salaries for management and audit and kind of stuff like that. Like kind of like corporate expenses that kind of aren't really related to the actual physical cost of the revenue of making clothes, is kind of like business expenses. You know what I mean? So, and here we kind of simplify it just because it's an introductory class. And so just a fuel, operating O&M, fixed O&M, and maintenance. So you kind of actually do need all these things to generate the energy revenue. And we kind of bake in the business costs in the variable and fixed, like the salaries and stuff. So then all this comes from the operations tab. And then you get once you sum these all up, you get your EBITDA. So that's earnings for interest, tax, and depreciation, amortization. So really, this is kind of like the true cash flow of a business. So it's a lot different from your cash flows available for debt service. This is kind of the physical cash that you're able to pay your debt, like the actual cash that will be in the bank account at the end of the period. Because you need CapEx and taxes, or you still need CapEx and some of these other items that aren't, like working capital, CapEx, and taxes aren't included in EBITDA. Those are kind of like exogenous costs that aren't really related to the actual business performance in that period. But you still need these costs to run to grow the company and continue the company. But we use EBITDA kind of see the true health, like the true quality of the business in that individual period. So that's kind of like the big difference between the income statement. So when you're kind of thinking about a company's performance, you're looking at it from EBITDA. And then when you're kind of looking at the actual cash to pay debt, you're looking at it on CFADs. And the CFADs are very similar to your cash flow statement too. Like they're more closely linked than So then you get your EBITDA, earnings before interest, tax, depreciation, amortization. We're not including amortization in this model because the amortization they're talking about isn't really debt amortization. It's kind of like amortization of accrued expenses. So sometimes you could accrue expenses or like goodwill and then you kind of like amortize it. So when you pay for that, say you bought that sweater for $1,000, but the sweater was actually worth, say, like $1,500. So you got it on sale. So you would kind of put that $1,500 value on your balance sheet as your asset, and then you would just amortize that difference, that extra $500 of extra value you got. You'd amortize that over like 10 years. That's not super accurate. That's kind of like the concept of goodwill, but that's a whole different thing that we don't get into in this class. But if you guys have the CFA and other stuff like that, then you'll get more. So anyways, we keep it simple. We stick with depreciation. So we take EBITDA, then we take out depreciation. And remember, depreciation is non-cash. And we're kind of doing this to kind of get to what our taxable basis is. So your EBIT is earnings before taxes. So this is kind of your taxable base. And then so this is all on tax law where you could remove interest expense and depreciation from your taxes. So you take away depreciation from depreciation tab and you get your EBIT, earnings before interest and tax. And you get your interest expense from your debt profile. And then you net that all out and you end up getting your taxable basis, which is your EBT, earnings before tax. And then your taxes are just 35% of your EBT. And then you get your net income. So when you see companies talk about earnings per share, it's basically your net income divided by the number of shares. So this is your net income. And this is the end of your cash flow statement. And then you kind of have this other stuff like your dividends. This will flow into so you calculate dividends in the cash flow statement. This is where it gets interesting. So dividends are actually a cash payment. So this is actual cash, not accounting conventions. And then so this is kind of separate from your true income statement. And then so this is kind of skipping ahead. Your retained earnings is your net income minus your dividends, and then your retained earnings will then flow into your balance sheet on the equity side. So retained earnings is not really cash out of the company. It's cash. It's basically cash that the company has made minus dividends and minus like everything else, and it's kind of cash, not cash, but earnings. So the difference between cash and earnings. Earnings is the accounting concept of how much the company has made, net of all the expenses. Cash is like actual hard cash. So there's kind of like a disconnect. It's kind of just a nuanced thing. So this is the earnings the company has made that it's keeping inside the company. So it's this money, accounting money, earnings that the company made, and they're recycling it back into the company. So you could kind of see you have your liabilities, which is debt. This is like stuff you bought with either your credit card with debt, or you bought with equity, cash that someone gave you from outside, or your retained earnings. So this is the cash injection from our equity holders. And then this is kind of like your savings. So like if you want to buy that $1,000 dress and you have a job and you just save that money from the job, and then you go to buy that dress with that money you save, that's kind of what your retained earnings is. It's money that you saved from your own generation of cash. And then this is an account, and this is like a stock. This is like your bank account balance. And then your equity is kind of like money your parents gave you. So it's money your parents give you, and then now you're working, and this is the money that you saved. And then your liabilities this is kind of what you put on your credit card. And then that's all the money into your bank account. And then what you spend that on is this. You spend that on so that money either goes into a bank account, which is here. So your parents give you money, and then where does that money go? It sits in a bank account, or you spend it on $1,000 dress, or you spend it on the weekend and stuff. So it's kind of or you buy like a house. That's kind of what the assets are. So anyways, so this is where the accounting gets really complicated. So your net income, so this is kind of how the three statements are linked, and this is like a classic financing question. So they'll ask you how the three accounts link. So part of that answer is that from the income statement goes down your net income. Your net income actually starts at the top of your cash flow statement, which is kind of weird, right? And then also part of that answer is, then once you go through the cash flow statement and then you get your ending cash balance, that goes to your balance sheet right here. This is from the cash flow statement. And then another weird thing is your retained earnings is dividends that you've calculated. So you calculate your dividends here, cash flow statement, and then you calculate your retained earnings on the income statement, and then that links to your balance sheet down here. So that's kind of like the answer to the question how the three statements are interlinked. Let's go through the cash flow statement. So we start from net income, and then we add back. Then you add back all non-cash expenses. So in our case, when you add back all non-cash expenses, it's just the depreciation. So in other instances where you kind of you've accrued expenses and then you amortize them, this is a whole, like this is like accounting like 2.0, 3.0 stuff. Then you would add back non-cash items like stock options, whatever. Don't worry about it. So you start with net income, add back non-cash expenses. Right now it's just depreciation. Then you include your increases, negative increases in working capital. So an increase in working capital of net working capital. So it's net working capital, net working capital. So it's negative. So an increase in net working capital is a use of cash. So in your cash flow statement, you're going to be noticing things are sources of cash and uses of cash. And then the sources are negative. The sources are positive. That's cash into the entity, aka the company. And then uses are negative, and that's cash out the entity, SPV, or the company, whatever you want to call it. And so you could see, so you invest in working capital, which is the cash in the cash register. This is kind of like the money you need to run the company day to day. It's just the bridge between your accounts receivable and accounts payable. So if you guys need a refresher on working capital, you're gonna have to Google it. Let's just make sure we're getting it's all good. So just get a refresher on working capital because I'm not gonna go over it again. So you invest $14 million in net working capital in the initial part of the construction period. And then whenever you need more money, then as the company grows, it needs more cash to kind of run a cash register. So then you're kind of putting in more cash into that working capital account. So you can see it goes up every period. And then you kind of see you have this period where you have those below 1 DSCR periods where you have all those costs or those revenues are down because of maintenance. And so since the company is contracting in those periods, it doesn't need that extra cash in the cash register to keep it going. So then you kind of return money back to the company as a source of cash, not a use of cash. And then so you have this huge positive decrease. Positive money is a source of cash from working capital. So this is a decrease in working capital. So it's a source of cash. So this is negative increase in working capital. This thing. So you can see it's negative working capital, negative change in working capital, negative net working capital. All right. And then the next period, revenues are back up. You need all that money back in the cash register. So then you got to invest back in. And that's kind of how it works. And then you kind of get this operating cash flow, which is cash flow from operations. And this is kind of like the cash the company makes. It's kind of like an EBITDA equivalent, but actuals. So like you can see the difference. This is the actual cash in and out of the company. And then, but you can see how EBITDA is very different from it, because EBITDA is kind of like an accounting convention. So we use EBITDA because it's like a truer sense of the health of the business, but cash flow from operations is very important from like a credit perspective. Because that's actual, like, so you could see like some like tech companies will have high EBITDA just because they're investing so much cash, and they're investing a lot of money. Like their only expenses are really salaries and like IT costs. So they look like they're strong companies on EBITDA, but then you go from cash flows from operations and really it's negative because they're burning so much cash. So like Tesla and Uber are good examples of this, where like a company looks good from an EBITDA perspective because they're using all these accounting laws kind of accrue the liabilities, and then and you're kind of just seeing one sliver of the company. Then we take a broad, like a more cash flow, like an actuals look. They're burning a shit ton of cash in their operations. So that's okay because they're investing a lot. But a growing company needs cash. So it's kind of, cash is almost like fuel for a company. So like if you're a growing company, like you're a growing teenager, you need more food, more fuel. So it's okay to be losing periodic cash, but your EBITDA will be getting higher because you're building value. But then say you're an older company or a mature company, you don't really need cash anymore. So you should really be spinning off a lot of cash. So that's kind of like the difference between, so that's why these maturing companies have such high dividends. It's because they don't really have a lot of growth prospects. And then, so they're just spinning cash off because they don't need as much fuel to grow. So they can spin off. Anyways, keeping it going. So investing cash flow is kind of like your CapEx spend. So you could see that we're building from construction. It's just kind of like our CapEx. We're investing in the company. This is exogenous from the company's day-to-day operations. This is kind of like money we're spending for future growth. It's infrastructure. So you can see where this is construction costs and land costs and CapEx. So this is stuff that we're using to support growth in the future. So it's outside the day-to-day operations, but it's something we need. So if we sold a piece of property, it would be a positive investing cash flow. This is kind of your plant, property, and equipment and stuff. Like this is cash you spend in that period. So then let's go down. Financing cash flow is kind of, and also keep in mind, this is all GAAP accounting. These last two statements get a little funky when you come to IFRS and GAAP. So GAAP's the American method. Then Europe and then in some other places they do IFRS, which is the International Financial Reporting Standard. And GAAP is called the generally accepted accounting practices. So there's just little nuances. Just note that this is GAAP accounting. So I know a lot of you guys are not foreign, but not American. And just note that there's a little more nuance and kind of like where things go and investing and versus financing cash flow, that if you guys are in interviews for international companies or companies not based in America that use IFRS, you just know that there's going to be a little nuance on that. And I'm not going to go into the details of it because it's very pedantic and you guys probably wouldn't know the difference anyways if I talked about it. So anyway, so you're investing cash flow, just stuff you spend money on. That's CapEx or construction, really, just stuff that's exogenous from operations. And then financing cash flow, it's kind of like not your savings, which is your retained earnings, which is not cash that the company generates. This is kind of like the money your parents give you or the money from your credit card. So this is like if you want to buy that dress and you're spending money on the credit card, that's kind of cash flow from the credit card, and then you repaying it is kind of like the repayment, or you repaying your parents for a loan, or you paying back a friend that you let him borrow money. So if you borrowed money from your friend, he gave you cash, then that would be equity drawn, and then you repaying that cash at a later date would be a dividend essentially. Or if you bought something on your credit card, like the $1,000 dress, and then you pay it off each month, this would be your principal repayment. So notice that your interest is kind of not included in here, and we kind of look at interest as kind of separate from. It's like interest is kind of like a fee. So your debt service includes your interest and principal, but on your cash flow statement, interest is kind of considered like a fee. So you're not really thinking about it as like an actual cost repay. So you're kind of hitting it in your cash flows from operations. It's almost like an operational fee, but really, from the accounting perspective, you learn more about the principal repayment. But from a credit perspective, like the cash flow, then debt service is important. Because really, our job is to make sure that we give the company just enough money. We want to give them enough rope, not to hang themselves, but 1 inch less rope so they can't hang themselves, if that makes sense. So we want to give them enough cash, enough debt, plus a cushion to where they could get the job done, but not too much to where they go bankrupt. So it's kind of like we're threading the needle there. So you guys ever heard that phrase? You have enough rope to hang yourself. You want to give them just enough rope so they can't hang themselves, like a foot less or something. You know what I mean? Or it could be more conservative and give them way less rope than they can hang themselves. But it's kind of what you're kind of doing here. You're kind of sizing up risk. So your financing costs are just from your construction tabs, and so let's see what they are. So I think it's just your it's your commitment fee, it's your underwriting fee, and I think it's your interest during construction. So those are your. Use hotkeys, but they're not working. Excel has a lot of hidden hotkeys, and if you don't use the right ones, you can kind of jam it up. I just froze Excel. Don't break. Don't die on me. All right. Let's go back. Let's see what the other one was. Yeah, so your underwriting fee, commitment fee, and I'm pretty sure it's your interest during construction. So those are your financing fees that kind of get capitalized. So everything I said about interest is true when you're paying interest, but we're actually capitalizing this interest during construction. So it's kind of like it ends up being a financing fee. So it's just like a little nuance. Like when you're paying interest off the loan, that's different than when there's interest accruing and then you're capitalizing it. So that's kind of more seen as like this all goes, these financing costs all get capitalized into the loan. So you're almost getting the loan net of these costs. That's kind of how it gets viewed. But you're taking out the loan more than you need to also pay the financing costs. So that's kind of just like how accounting breaks it out. So you have the total loan, and then we're kind of netting away these fees that we have to take extra loan out to pay. So it's not the same as just periodic interest during your amortization period. It's just a little different. So just note that this is just the debt drawn and the equity drawn. And then during your amortization period, it's just negative your principal repayment and then your dividend, which is from, and then so your dividend, we calculate here actually. So you could almost see as your dividend as like a sub thing. So really the sum of everything above it. So all the cash above it, this is almost like your, so this is almost like your cash available dividend. Really, this is just all the cash left over from the company after you go through all this stuff, and then you just take 50% of that, and that's your dividend out of the company. And then so your financing cash flow is not really that, but sorry. So then your financing cash flow is kind of the principal repayment and then your dividend. And then your dividend's calculated by just the sum of these guys up here. And then you can kind of do that in the cell, or you could do it separately and then link it. And then that's your financing cash flow. And then your cash, and then all that ends up to your net cash flow for that period. So that plus that plus that. And then that goes your cash balance beginning of period, cash balance end of period. And so you're really just accounting, you're accruing all this stuff. So another thing we're probably gonna have to do is when you have that debt service reserve account, that's called restricted cash. So your restricted cash is cash you've generated, but you can't really touch because it's locked up. So when we do this, we'll put this on the balance sheet like regular cash and then restricted cash. So that's TBD on how we model that. I'll show you guys that for the next session. So then note your cash balance end of period will then flows into your cash here. So then the balance sheet, which is probably the most technical with accounting. Your initial working capital, you just pull that from there. You put your cash from the cash flow statement, accounts receivable, working capital, PP&E from your end of period PP&E from your depreciation. And here's your non-depreciable assets, which is just your land. They have land. And then that's the sum is your assets. This is your uses of capital. What you've spent your money and debt on, your equity and debt on. So as a company generates revenue, aka earnings or revenue, then you have to pay all your expenses to generate that revenue. Then you have to pay off your debt outstanding. Then you got and then from there you pay off all that stuff. Then you get your net income, and then you go through the cash flow statement. Then you get your dividends, and then so that tracking of your paying off your debt and then your dividends, then your net income minus dividends, which is retained earnings. So your savings, then you repaying your debt. That's kind of how it balances. So your assets equals your liabilities plus equity. So there's kind of like a cool little dance between the asset side and the liabilities and equity side. So I'll have to find, let's see, there's a whole process on how they all interlink with each other, how your net income kind of how your cash balance really. So really in accounting, you have the two basic accounting statements are your income statement and balance sheet. Those are the two most important ones. Those are the two fundamental building blocks of accounting. And then your cash flow statement is kind of like the reconciliation. It's between your income statement and balance sheet. So if you took the income statement and directly fed that into a balance sheet, there would be kind of like a disconnect on what's going on. So really your cash flow statement is the reconciliation. It's kind of like your walk between what actually happened and what hits the balance sheet and what your income statement says. So when you generate revenue, and then you spend it on your COGS, and then you have all these earnings and depreciation and taxes and stuff, and you get this net income. And then you get your retained earnings, which is your net income. Like I said, this retained earnings goes on your balance sheet here on your equity side, right? So when you make money, your and minus dividends, your equity side increases. But then when you have an asset and it depreciates, your net income gets lower each period from depreciation. So your actual retained earnings is lower because of depreciation. And then how does that sync up on the asset side? on the asset side, you have your PP&E net of depreciation. So you take depreciation out every period. So this is actually lower each period because of depreciation, right? But then also your retained earnings is lower because of depreciation, right? And then, but it's not apples to apples, right? Like your retained earnings is only lower by a small amount after depreciation, because then you have to take out interest expense and whatever, right? So your PP&E is lower from the depreciation hit is greater here, and then lower for retained earnings. So how do you bridge that? This is the larger decrease here versus the smaller increase there, right? So this is increasing while this is decreasing at a large amount. So what happens is with higher depreciation, that means you have you add that back in your cash flow statement. So the more depreciation you have, you add that back, so that increases your cash flow statement. That ends up down here in your cash balance, and that cash balance is higher here. So when you have depreciation, the depreciation is realized on your balance sheet on the retained earnings, which are lower because of depreciation, and your PP&E is a lot lower because you're realizing the full depreciation. And to kind of bridge that low decrease versus a big decrease, you have higher cash. So if you take the depreciable effect, it lowers your retained earnings by a little bit. It lowers your PP&E by a lot, but then it increases your cash by a medium amount. So the net effect is this side balances with that side, which is kind of like a cool way for accounting, how it flows through. Everything flows through and interlinks. So you may want to listen to this part again. It's very confusing. I'll repeat it again very quickly. Is depreciation lowers your net income, which in turn lowers your retained earnings by a small amount. And then depreciation lowers your PP&E by a large amount, by the full amount. But then as you go through your income statement, so just going through the income statement, you get depreciation hits your EBITDA, then your EBITDA goes to your net income. Or you hit depreciation after EBITDA, then it hits your net income. Then your net income flows to your retained earnings. So then that's how your retained earnings are slightly less because of depreciation. And then your PP&E is just lower each period because of depreciation. But then your net income goes to the top of your cash flow statement, and you add back depreciation. So your cash flow balance at the end is slightly higher. So this is slightly higher, this is lower, this is slightly lower, and then that's how these two keep in balance. And so that's how depreciation gets flowed through. That's one of the cool things with the balance sheet. So I'm only saying this because your balance sheet will not balance. It is very hard to get it to balance. It's going to take you guys a while to get it to balance. And that's just think about how it flows through. And with the depreciation example, that's kind of a way to troubleshoot it, because you don't really see where it's not balancing. You kind of have to go upstream and kind of play with things until it balances downstream. Your accounts payable and accounts receivable. So kind of just this difference between the two of these is your working capital needs. So this FYI, it's another way to calculate working capital. And then that's your balance sheet. You just got to get everything in balance. It's going to be difficult. Beginning of period, end of period, from the retained earnings, accounts payable, it just has to balance, and just be careful about how you generate cash, how things flow. It's going to be a little complicated. Anyways, going on to valuation. This one. So your leverage valuation, you just take your equity contributions from construction, and then your dividends from. So your leverage valuation just means equity return. And since it wasn't paid 100% with equity, it's leveraged. So that's what I call a leveraged return, or your leverage valuation. It's just your return. It's return on equity using leverage, aka debt. So this is your equity into the company, which is your equity contributions, and your equity out of the company, which is your dividends. So from your perspective, so this is from the perspective POV of the equity investor. Why the numbers are negative. So this is from the equity investor, it's just money out of your pocket, and so it's negative, and then it's positive here because it's money coming back in your pocket. So these are your cash flows, money out and then money in, just the length, and then your cost of equity, aka your this is the opportunity cost of capital, you know, like CAPM, all that stuff, whatever, like risk adjusted. This comes from your assumptions. Then you do a net present value calc. So you do X NPV. And also remember, don't do this first date because it has to be negatives for these first couple of years. Sorry for the IRR. It can't be included there because it'll break and it'll break the calc. But just remember, just to have the first year where there's money. And then so this is the discount. So the NPV is just the net present value, which just takes the discount of, use X NPV and use the date. So it just takes the discount. It just discounts the cash flows based on time and the discount rate. So our NPV is actually 0, which is bad. You want NPV, you really want a positive NPV. But then our IRR isn't the worst. It's 11.69. So an IRR is just what our cost of equity would be to get the NPV of 0. So I'll show you guys a trick. So if this equaled our IRR, our NPV would be 0. Boom. So an IRR kind of like your hurdle rate. It's kind of that inflection point. So it's kind of like your double derivative. So it's the inflection point on when the cost of equity, what the cost of equity would need to be to make your NPV 0. So let's do it again. Check that out. Boom, 0. And IRR is skewed towards a time. It's like a time-weighted return too. So you kind of want to use your NPV as your first choice on evaluating a project, but IRR. So if your cash flows, if you have higher cash flows, so say you had a lot of cash flow, say you had $1 million cash flow over 5 years, and you get $1 million the last year, versus say 5 million in year 2, and then 5 million in the rest year 5. The one where you get money earlier is more valued. Is the IRR will skew that one towards the earlier payment. So say you get 10 million in year 2, or you get 20 million in year 20. Obviously, you'll probably choose the one that's more, but IRR will probably choose the less amount of money that's closer versus a larger amount of money that's further away. It's just a time weighted bias. So when you're evaluating projects, your NPV is usually the first choice, and then your IRR is kind of like a secondary metric. It's about how much it costs to return your capital, or whatever. Don't worry about it. But then here where it gets a little weird, this is your unleveraged valuation. So this is kind of like what the cash flows would have been without all the debt. So you have to. So when there's debt, there's costs and benefits. So with the debt, there's more depreciation because you're depreciating some certain assets. Sorry. So here, let's go. So really, it's there's just a couple things that are different. So like you wouldn't have those you wouldn't have the financing fees. Your actual cost of the project would be less just because you're not having to pay those financing costs. You would have more periodic cash flows because you're not paying off all that interest. There's a couple of nuanced things that are different. So you stick with EBITDA. Depreciation is, let's see. Your taxes are also different because you're not oh, here, sorry, someone sent me an email about, let's see. Yeah, so the question is, if you could follow the statements that you're going over with what you show on the video. As well, yeah, sorry. So here, I think he's referring to how depreciation flows through the income statement and cash flow statement. But I'll go back over that through the end. But anyways, so your taxes are actually higher when you pay all equity because you're not deducting that interest expense. So your depreciation, so your taxes are lower. So depreciation, I think, is still the same. Or no, sorry, it's down here. So let's just go through it. So from here, we got to start down here. So your depreciation is slightly different. Your depreciable balance is, so this is why it's different, because we're not able to depreciate the financing cost. So if you notice, since there's no financing cost, since you notice back in the depreciation tab, come back, your initial depreciable base, this includes all these costs. So these are all financing costs. So if we're just paying with equity, we would only be paying that. We don't have that. So our depreciation is just slightly lower, and that's what we got to do here. So your initial depreciable base is lower, and then so here we just rebuild that calc. But this doesn't change our capex depreciation. So capex depreciation unchanged. So really, it's just the beginning. And then you just rebuild the calc, straight line, 60 periods, that amount down here. This is our adjusted depreciation. So then you link the adjusted depreciation up here, and you start with EBITDA, then you kind of rebuild your income statement with these different adjustments. So this is your adjusted EBITDA from below. This is your adjusted EBIT. There is no interest expense, so your EBIT is so there's no interest expense. So EBIT equals your EBT, your taxable basis. Your adjusted depreciation is your initial depreciable basis without financing costs, fees, and those are the fees and interest during construction. Right. And then that's your EBIT, and then your adjusted taxes is just 35% of that EBIT, and then you add back depreciation. Then your increases in working capital are the same, and then your investment costs are the same. This is just your scheduled payments. And then your capex is all the same. Then you kind of get this new unlevered cash flow. And then this is kind of what the cash flows would be if you didn't pay debt, or if you never paid with debt. So then our WACC comes from our assumptions tab, and then our NPV is the same thing, XNPV, dates, discount the NPV, and then you get 9.3, and then our IRR is XIRR. Remember, use the dates. Also remember, skip that first period, because see if you look, if we have it, if the first period is negative, it totally messes it up. But just remember to keep both. Start from H. And then another thing, so let's see. So you could see, so you kind of want your WACC, or sorry, your NPV. So if your WACC, or your cost of capital, which is either your weighted average cost of capital or your cost of equity, if that's higher than your IRR, then that means your NPV is going to be 0. But if it's lower, that means your NPV is going to be positive. So see if we increased it, the IRR, 0. It's kind of like your rule of thumb. So you kind of want your WACC, your cost of capital, to be lower than your IRR for it to be positive, to get a positive NPV. Because your IRR is just the cost of equity, or the cost of capital, to get your NPV to be 0. Then your cost of power generation. This is kind of like a specific metric for this is like the all-in cost of power. It's kind of just the dollar amount divided by. This is kind of a way to compare different power projects, different types of power projects in a more standardized way. So if you're kind of comparing like a solar project with a natural gas project, it's kind of what you use. So this is your power generated from time and technical. This is notice how it's megawatt hours, and this is just your revenues. And then this is the all-in cost of power is just, so you have to convert down from megawatts to kilowatts. So it's just kind of the kilowatt hour. So megawatts to kilowatt. So kilowatt hours, the cost. So it's the dollar amount. So this converted to megawatts and then just divided by this. So you can see how the formula works, right? So just this divided by 1,000 is just the way you convert it. So another way to do it, I think, would just be, you could times this by 1,000. You could times that by 1,000 to get to your, this is now kilowatt hours. Kilowatt hours, or then your money divided by kilowatt hours. Yeah, and that's your all-in cost, and then your average is just the average of it. But remember, don't take the zeros, because if you take these zeros, it ends up skewing it down. So let's just to show you guys, see how it went down. It's considering these zeros in the cost, and then that's your valuations, and then your bank return. This is really interesting. Not a lot of people cover the bank return on capital. So they call it, it's the bank return on regulatory capital. So banks are weird. They're not like companies. They're kind of just pass-throughs for, they're pass-through vehicles of capital. Like they don't really do anything except allocate capital. So they don't really sell anything. Like they borrow money on, like they get deposits, long-term deposits, and then they just re-lend those out to companies. So they borrow short and lend long. So they're pass-through vehicles for capital. They just allocate capital. So they don't really have like cost of goods sold and that type of stuff. So the way to evaluate banks is they have to hold, due to Basel III regulations, like banking regulations, they have to hold a certain amount of core equity. So they have to hold some cash on their balance sheet. So this is capital they have to hold that they can't lend out, and that acts as like a capital cushion against the riskiness of their loan book. And the amount of equity they have to hold is based on some type of regulatory calculation of the riskiness of their loans they're giving out. So really, their cost is the amount of equity they have to hold based on that's the amount of equity they're not allowed to lend. So it's kind of like their cost. It's kind of like a drag on their returns. So really, we're finding the return. We're trying to find the best use of those returns. So it's kind of like a zero-sum game. Like you have, say, a bank has $1 billion in capital. Say a million people put $100 in each, like a deposit. So then the bank has $1 billion to lend out. So it's kind of like a zero-sum game. So there's some type of optimization there where depending on the riskiness of, so say they went safe and they put all that money into like bonds, and the bonds only return like 5%, and then they hold, say, 1% regulatory capital. So really they make like a 4% spread. It's kind of what they make. But then say they took half of that, they took 500 million and they invested it in project finance, which is very risky. But then they have to hold, say that project finance only returns 10%, and then say the project finance only returns like 5%, and then the regulatory cost of that capital is, then you have to hold way more capital against it. So instead of holding like 1 million, you have to hold like 100 million. And then so that's 99 million of equity that's not in the bond market or in the money market where it's accruing money. It's you're kind of just like you're kind of playing this game of capital allocation where the risk return profile of a project finance loan has to outweigh the amount of regulatory capital that you hold against. And that risk return, the risk part of the return is the regulatory capital that you have to hold. And that's like a regulatory thing. So it's just like a really conceptual, this is like a really important conceptual thing. I know a lot of people will probably end up working at the Federal Reserve or central banks, but this is kind of the crux of banking regulation, is making banks hold enough capital cushions to hedge against their risky loan book. And that's kind of how you throttle bank returns as you increase the capital they need to hold. So that's kind of like long about it. So the spread really is, this comes from the assumptions. This is the probability of default and loss given default. So your expected loss is kind of just the sum of these two, is the product of these two. It's kind of your expected loss. And so probability of default is where I work, it's called PD, probability of default, and it's kind of like the overall risk of default. It's just the risk of default, percentage wise. And I think 7% is very, very high. This is a risky loan. So if you go to Moody's, if you go on to Moody's.com or you Google probability of default and you find the rates, you can kind of see the different credit metrics like triple B plus, triple B negative, lowercase b, and they all map to different probabilities of defaults and like loss given defaults. It's just like these are all credit metrics. So I know some of the people, and then loss given default is loss is in default. How much of our loan will be lost? So kind of like, AKA the unsecured portion of the loan or uncollateralized. If it goes under completely, we would lose 35% of our loan. But that would only happen 7% of the time. So 93% of the time, you're probably good. And then so your expected loss is really 4.45. So then another way banks make money is not just on the spread between borrowing and lending. They also make money on fees. So initial K is 15%. K is the regulatory capital requirement. So, and the regulatory capital requirement is, there we go, is that it's the percentage of the loan of the principal outstanding they need to hold on their books. So you can notice the reduction in K as the principal gets paid down, you return that capital back to the balance sheet and the banks can re-lend that out somewhere else. So this is just the fees and just receive cost of funds. So this is what the bank borrows at. So this is kind of the interest they pay to the depositor. So when you deposit money in a bank, you get some type of interest rate on the deposits. This is kind of what it is. But for a bank, it's not always deposits. It's also like the money market. So they'll borrow like repos and they'll borrow money from the money market, these short-term overnight lending. Like they'll literally borrow like hundreds of billions of dollars overnight. And then they'll take that money and they'll roll it over every day. And then that's what they do to pay the loans and stuff. So they borrow short, lend long. That's kind of what the risk is with banks, is the time difference. So really that's what happened during the financial crisis, is that they couldn't fund a lot of banks went under and it spooked the market, and they couldn't get access to the money market. They couldn't get these repos and commercial paper to fund the banks day to day. So really the banks are super levered, where they really don't have enough money every day. They got to borrow every day to pay all their stuff. So they couldn't get access to that money, and then they were insolvent. So they were illiquid. So there's a difference between being. So they were a lot of these banks like JP Morgan and Goldman Sachs they weren't illiquid. They weren't insolvent, they were just illiquid. So insolvent means all their, like Bear Stearns was insolvent and illiquid. Like their loan book was terrible. They lost all this money, and they couldn't have access to the day-to-day liquidity to fund to operate day to day. So when you're illiquid and insolvent, then the bank goes under. But if you're solvent but illiquid, that's kind of like JP Morgan, Goldman, where they took losses, but they didn't have as much losses as like Bear Stearns. They just couldn't get access to the day-to-day money to kind of fund the bank. So an example would be if your car breaks down and you notice that it's out of gas, or you take it to a mechanic and he says that the engine's broken and you're out of gas. So that's being illiquid and insolvent. That means the engine's broken, so the car can't run. That's insolvent. That means your loans aren't worth anything. And then you're illiquid, you don't have any gas to run. So your car's basically shot. It's done. But like then that's Bear Stearns. And then kind of the other banks that didn't go under, like Goldman Sachs, they when the car breaks down, and it just turns out they don't have enough gas, that they're just illiquid. But once you put gas back in it, the car runs and you can keep going. That's kind of what the Federal Reserve did when they gave all these guys money. That's an aside. Anyways, that's kind of how this thing works. And then this is your expected loss, which is just probably default times loss given default times your previous period and your period's principal outstanding. Right? So part of your expected losses, this is all part of like the regulatory capital. So you have your regulatory capital as a percentage of the loan outstanding. Then you kind of have your expected loss that you have to hold against. And then you have your admin costs, which is the cost to service the loan. So you have all these ops people who kind of have to like manage the money coming in and out. And then so this is the principal outstanding. So there's the initial reduction in K. So it's your total loan commitment times that. So that's why there's a commitment fee, is you kind of have to fund this initial K. So the commitment fee of dry powder, on the money that oh, I think the screen froze. Wow, the screen froze on you guys. Shit. Let's see if that's better. Yeah, so sorry. I think the screen. Fuck. I think the screen froze on you guys. So obviously it wasn't as useful. I think it froze a half hour ago during Time and Techno. Someone's shooting me emails telling me. So I'll go back through. So this is what I was talking about. So hopefully it works now. I think it works now. Fuck. So anyways, so here's probability default. Now you guys can see it. This is what I was talking about. Loss given default, expected loss, regulatory capital requirement is K right here. And you just pull this from your construction plus debt profile times the operation flag. So it's kind of like the trick to turn off construction versus debt profile. Initial K only shows up in that period. Upfront fee, which is from construction. And then, so it's money into the bank. And then here's cost of funds, all from assumptions. Expected loss. Anyways, and then so you just kind of sum up from initial K down to there. And just remember your reduction in K. Your reduction in K is this is the yeah, you can check out the formula. It's really just the difference. It's how much less money is owed. So it's how much money has paid down. So this is how much your loan is getting de-risked. Money's coming back. So just 15% of that is your reduction. So let's see. Times the 15%. Yeah. So this is how much less regulatory capital they can hold. And then your expected loss is like a periodic thing. So your expected loss is just the expected loss, the 17 times that times your principal, your previous period's principal outstanding. So this, and then your initial K minus the reductions is the regulatory capital they have to hold against. Your cost of funds is the cost of borrowing money to lend long, and then interest received as income, and then fees are income. And then so this is your initial K. It's like a balance, and then it slowly gets chipped away to zero as it goes through. So these are just the periodic cash flow. So this is all flow variables. And then your net cash flow is just the sum of all that. And then it's just another NPV. So it's just the X IRR. And then, so this one, we don't even do, we don't even have a cost of capital. It just kind of guesses it. Just do guess. And you get this 18%, $17.99 as your bank return on regulatory capital. So really, that's what banks do. They can invest in project finance, and then there's a regulatory cost, and then there's an income, there's an interest income, and then, or they can invest in like municipal bonds, which have a lower return but lower regulatory costs. So you'll have this different bank return on regulatory capital across different lines of the business of the bank. So that's how banks kind of do it. So you ever hear about earnings, how the trading business did well, but the investment banking business did poorly, or vice versa, or like equity trading did very well. What they're looking at is the bank return on regulatory capital. And so they'll kind of like guide their businesses based on this bank return on regulatory capital. So that's kind of why a lot of these trading businesses have been cut, because they increase the size of the regulatory capital, and there's just not enough profit on that. And that's why the investment banking groups are getting more profitable, because they make all their money on fees. And so there's not a lot of regulatory capital they're putting out. So, an aside. So I guess it got locked up when I went to time and technical, which I think was during the cost of power. So I think we covered the adjusted depreciation in that. So if you guys have any more questions, feel free to shoot me an email. This will be posted. I'll have another TA session, more like office hours, on Sunday. If people have more, if it froze too long ago, and people have more questions, I could go over kind of how the income statements work. You just feel free to shoot me whatever email questions you have. I'll be available. If there's a lot of questions on, especially like how the income statements, balance sheet, income statement, cash flow statement intersect with each other, I could do another video on that, because that's pretty complicated. I'll try and send around some help on, because there's people who map through. There's help where you can map through the different statements, and that's kind of helpful to help you balance your balance sheet, just how things flow through and where you can troubleshoot. But that's it. This was a long one. Sorry, guys. But yeah, feel free to shoot me emails, subscribe to the page, etc. All right. Thanks a lot.